It's Fed Hike Day, that special time of the month when all Americans unite to reflect on the important things in life that the Fed plans to destroy this month. Jerome Powell is expected to hike rates by another quarter point to 5%, the highest since right before the 2008 financial crisis. But don't worry. He's telegraphing this will be the last hike for a while, after which the Fed repairs to its mountaintop lair to survey all that it has crushed. Now, an optimist might say the Fed's done smashing up the joint, mission accomplished, maybe we can stop hurtling towards the ground at full speed. A pessimist might note the damage is already done, going by jobs and banks, while inflation hasn't gone anywhere. The Fed is simply giving up, admitting it has painted itself into a corner, meaning after this, it's hopes and prayers. So what went wrong? Jerome Powell knew that the fastest rate hikes in 50 years would crush jobs. In fact, he bragged about that repeatedly last year. He should have known they would also crush banks, since crushing jobs means crushing companies, means lots of bad loans. Exquisitely paired with the well-known fact that rate hikes crash the bonds that make up most bank assets. So why did he do it? Because Powell knew bad inflation numbers are a huge political risk to the Fed's power. Politicians would take it away. Yet he was unwilling to stand up to those same politicians over their $7 trillion in deficit spending that drove inflation. Instead, he opted to crash jobs and crash the banks to make the rest of us cut back so the feds could keep spending, essentially flatten all of the cars on the highway so the feds can drive faster. So what's next? Going by recent inflation numbers, this final quarter point kick in the teeth won't kill inflation, which has metastasized in recent months at about 4.5% core. Meanwhile, yet more regional banks are crashing this morning, with distressed Western Alliance and PacWest currently sporting double-digit declines to go with their 20% drops yesterday. It's worth mentioning that in our last financial crisis in 2008, we had a few big banks go under early on, and then hundreds of regional bank failures in their wake. So given that we've just had the second, third, and fourth largest bank failures in U.S. history, going by history, we are due for a lot more. Finally, jobs and economy. I mentioned crashing job openings the other day, which are down 1.5 million in just 3 months, while layoffs soared to 1.8 million on the month. Meanwhile, new jobs numbers expected today and Friday are signaling lower wages, more insecure workers, and people coming off the sidelines, not by choice, but by necessity. Combine all that with the crash in commercial real estate, a mainstay of regional banks, and the near freeze in business lending, which is the lifeblood of the small business loans that regional banks live on, we can expect more bank collapses to go with the jobs collapses, and unless we get a deficit miracle out of the debt ceiling showdown, a lot more pain. Okay, we'll be watching. See you next time.